I warned you this would happen. The White House is panicking, and I'm going to show you the real reason why President Trump is on the verge of declaring an all-out national crisis. Plus, tonight's show is brought to you by Clean Core Solutions. You can find them on the NYSEA under symbol zone. And let me tell you why you want to look them up, because they're the Dogecoin treasury company with Elon's lawyer at the helm and an actual treasury deal with the actual Dogecoin founders. And if you're into gap trading, you're going to love this chart. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's turn to Bloomberg, where we picked today's story up as Trump weighs declaring national housing emergency. This according to Treasury Secretary Bessent. And I want you to understand why this is so important, because the housing industry, when you think about new construction, it employs millions of Americans, and not just directly from the actual construction of the house, but you've got everything from sales to financing. And then you have the indirect jobs, because houses need things like air conditioners and appliances, and those are called durable goods, and that flows right into the heart of the U.S. manufacturing sector. And the real risk we're facing here is there is the largest overhang, the largest inventory of new construction homes sitting on the market, and there's a lack of buyers. And that, my friends, is a huge problem, because when you lose the housing market, well, you lose the economy, and that could be the case of why we're on the verge of a national emergency. Bessent said housing affordability would be a critical leg of Republicans' 2026 midterm election platform. He declined to list any specific actions the president may take, but he suggested that the administration officials are directly studying ways to standardize local building and zoning codes and decrease closing costs. But the problem here is they don't have an answer. And this is the same answer that we're lacking for the rest of the economy, because we have a massive inventory buildup post-pandemic and due to front-running of the tariffs. And yet, as we continue to look at the state of the economy, it's going the wrong direction, and policymakers are lacking answers here. Now, even if we were to cut closing costs, well, I want you to see it would make absolutely no difference and still put us right on track for a housing-led recession. In Trump's relentless attacks on the Fed this year, he's argued that high interest rates have added to the government's financing costs and damaged the housing market. But Mr. President, I don't agree with you in this case. I don't think it's interest rates that are keeping people off the line here. I think the real issue has to do with the economy and about affordability. And yes, we could say that if interest rates went down a little bit, that would increase affordability, but that's not the heart of the issue. It all comes back to the labor market, and there's a big problem with the labor market right now. It's the fact that people aren't getting the hours they need, and a simple rate cut isn't going to bring housing prices down enough to offset the difference. Let's take a look at this chart of new privately owned housing units started in blue against average weekly hours of production of non-supervisory employees in red. And I want you to see the very clear relationship here. And again, it's not about interest rates, it's about incomes. And here you can see incomes going down in the mid-80s all the way into the 90s recession. And what happened? Housing starts dropped right alongside with it. We see the same thing happen in the late 90s. As hours dropped, builders continued to add to their inventory, and then they started cutting. We see the same thing going into the global financial crisis, a lead going into the pandemic, and a big drop-off since, of course, around 2021 as hours decline and housing starts have dropped, suggesting we're about to see a huge drop in housing starts. And again, this all backfeeds right into the real economy, because if builders cut back on the number of homes they're building, well, they cut back on the number of people they need to build those homes, and that could be the tipping point that sends the U.S. economy right into a recession. Because it's all about the labor market, let's overlay the unemployment rate in red, and what you can see very clearly as builders scale back, well, their need for employees goes with it, and that backfeeds all across the economy, and you see the unemployment rate rise. And it happens nearly every time there's a drop in housing starts, and the problem is when you get a drop in housing starts and a rise in the unemployment rate, well, it tends to push us right into recession, and that's the risk we're facing right now. Is we're on the cusp of builders having to cut back in a major way, and that would send the unemployment rate rising, and now you're talking about an all-out national emergency. But something else that is set to surge a lot higher is our stock for our sponsor today show, Clean Source Solutions. Again, you can find them on the NYSEA under the symbol ZONE. Let's take a look at this chart, because today as the market went down, you can see that their stock gapped down and buyers flooded in. Now this red line is the 6-month volume profile, so you can see there's a ton of buying support here. And if you're into gap trading, well, to close that gap, you need to see the stock rally 100%. Everything you need to know in the pinned comment and description below. Stay tuned for more information. Because it's not, again, the U.S. issue, it's also a global issue. Let's turn to the U.K. as housing prices post surprise August fall. And again, this is a global issue because I want you to understand the relationship here. And this is the same thing we're seeing in China. Housing prices are dropping, and what's happening? People don't want to buy. Now we're seeing it happen in the UK. And what are we seeing already? The beginning stages here in the US is that demand for housing is dropping, and those who need to sell are cutting prices as builders are also slashing their prices. And again, this isn't a good sign because people like to buy when prices are rising, not when they're falling. Housing prices are still high compared to household incomes, and I love this statement because it makes absolutely no sense, because the real statement should be is that incomes did not keep pace with housing prices, and that's the real problem here. It's not about the price of homes, it's about the ability for workers to afford them. And again, it's not about interest rates, it's not about closing costs, it's all about hours and jobs. And this is making raising a deposit challenging for prospective buyers, especially given the intense cost of living pressures in recent years. And again, this isn't just a UK issue. Look here in the US. What was one of the issues I flagged about our economy? Well, it has everything to do with energy prices. We've seen a very hot summer. Electric bills have surged, and that means, again, it's tapping money that could be spent in the discretionary side of the economy, maybe could go to saving for a new home. And what we're facing is consumers all around the world are struggling to keep pace with inflation, and that means as housing prices come back down to reality, there's going to be fewer buyers, and what we're facing is an all-out national emergency. Aspiring homeowners are facing fresh increases in basic bills while rent prices are outpacing pay. And again, it's coming all back to pay. And that's making it more challenging to put money down toward a deposit and service a mortgage. So if you think about what's going on here in the UK, again, they have the same issues that consumers have all over the world. And if you cut interest rates a little bit or you cut closing costs, that's still not enough to push people over the bar, because when we look at the recent survey data, what have we seen? Consumers are worried about their job. They're worried about their income. And when that happens, it's a leading indicator that hours are about to drop. And we know when hours drop, well, that means jobs are going to get lost. And the problem is right now there's going to be little opportunity for people to re-enter the workforce. But when you look at the relationship between consumer sentiment and housing starts, it's shocking about what's to come. Let's now overlay the University of Michigan Consumer Sentiment Survey in red against new privately owned housing starts, still in blue, and you can see the very clear relationship between the two. Now, the risk is right now is we saw sentiment drop, but we haven't seen a drop in housing starts, and this is exactly what the White House is worried about right now, and the same reason they don't have an answer for it. Because again, you think about, well, what if the Fed just cut rates 50 basis points? Well, that's not going to make homes that much more affordable. Well, what if we cut closing costs a little bit? Well, that's still not going to move the needle enough. The reality right now, based on what we're seeing in this chart alone, is that plunge in consumer confidence is about to hammer the housing market, and that's going to affect the income of millions of Americans, some who will be lucky to keep their job but just see their income drop. Others are going to be out of work completely. And again, this is spilling across the global economy. Let's turn to China, whose home sales slump extends as prices continue to decline. Now, when we talk about China, remember, they've tried to stimulate their economy. And I've said over and over, it's not going to work, because the problem is policymakers have forgotten how to grow an economy. And they think if you just throw enough stimulus at it, it'll work. If you just give people some incentives here or there, it'll work. But the problem is it doesn't stick if you don't have jobs. And that's the problem that China's facing right now. The value of new home sales from the 100 largest property companies stood at 270 billion yuan, and that's now a 17.6% drop from a year earlier and fall at a 24% slump in July. Sales now have fallen 6 straight months. So you think about China's economy, and what's the issue they're facing? deflation because demand's dropping. And you think about housing, it employs lots of people there, lots of people in the UK and right here in America. When you lose your housing market, well, you lose your economy. And that is, again, could be enough for President Trump to trigger an all-out national emergency. The question is, how will they respond? Well, that we'll find out soon enough. As China's housing slump has dragged on for more than 4 years, with sales falling further since the second quarter. The worsening decline in prices also signals the effects of a stimulus blitz a year ago are wearing off, stoking concerns about deflation. Now, how do you get deflation? It's called too much supply and not enough demand. So as we look around the global economy, and in particular here in the U.S., what do we face? Inventory levels that are sky high, and people are still building because they want to get things in before the tariffs set. The problem is consumer demand is dropping because paychecks are shrinking. So what happens again? You have too much supply, not enough demand. You have competition to lower prices. This is exactly what's happening in the fast food and fast casual space right now. And next thing you know, everybody's competing to lower prices, and that's when things spiral right out of control. But as I started the show, this all back feeds into the manufacturing sector, and the problem is it's a key link to the housing market, and for the U.S., it's about to fall right off a cliff. As U.S. manufacturing activity contracted in August now for the 6th straight month. Now keep in mind, when we go back to the beginning of the year, what did policymakers tell us? They said that the economy was going to slow down in the first half and then surge higher in the second half. In response to that, what did we see? A lot of companies went out and built inventory. Then we got the trade war, so they built more inventory. And the problem is the labor market didn't keep pace, and now things are facing a dire scenario. The Institute for Supply Management's manufacturing index came in at 48.7 last month, and keep in mind anything under 50 denotes a contraction. So this is a problem because it's now for the 6th straight month. So any bottom in manufacturing here? Well, we're not finding it, and that's a problem because these jobs tend to be higher paying. And again, you think about the link to manufacturing to the housing market. As housing starts go down, well, again, the need for durable goods and supplies for the housing sector go away, right along with jobs. The group's index of factory output sank 3.6 points to 47.8, moving back into contraction territory for the first time in 3 months. And this is a risk that I've been flagging, is when output drops, it hits the labor market. And let's take a look. Because the group's measure of employment inched up but remained one of the weakest levels since the year of pandemic. And I love how the media covers this up, because what they didn't want to say is that the employment sector is in contraction. And when manufacturing employment is contraction, it spills over to the services sector, and then it shows up in the non-farm payroll report. And that's what we're going to get on Friday. And nobody wants to see a weak non-farm payroll report, and no one wants to see that the QCEW revisions are going to say that the Bureau of Labor Statistics overstated jobs by several 100,000 or maybe 500,000 jobs or more. Again, this is all warning signs for what's coming for the U.S. economy. Let's take a look at capacity utilization. This is the percentage of a factory that's being utilized against the unemployment rate. And I want you to see why manufacturers are laying off, because as capacity of a factory declines, the need for labor goes right along with it. And you can see throughout history, when you have a corresponding decline in capacity utilization and a rise in the unemployment rate, it means we're likely headed right into a recession. And that's the risk here. With 6 straight months of declines in the manufacturing sector, the layoffs are starting to build, and they're only going to get worse. But there was a little bit of good news, because at the same time there was a few hopeful signs about the outlook. New orders expanded for the first time since the start of the year, and the ISM gauge of new bookings jumped 4.3 points, the largest increase since the start of last year, to 51.4. So what you got was a slight expansion in new orders here. So the question is, why isn't that leading to an increase in employment or an increase in hours? Because there's another major issue that we've been flagging, has everything to do with backlogs. But because demand is going down, what we're seeing is price pressure is abating as well. A measure of prices paid for raw materials declined to 63.7, still elevate, but the lowest since February, suggesting that disinflation now is building into the manufacturing sector. And that follows a 4.9 point drop seen last month, suggesting that tariff-induced price volatilities are subsiding. It's also suggesting that the Fed's claim that we're going to see tariff-related inflation is completely overblown, because what I was worried about, what I've warned about, is that demand could drop faster than price increases get pushed across, and then at that point, you're going to see disinflation. The risk is it turns into all-out deflation. But let's look at the real numbers here, because, well, the media didn't want to tell you about the backlogs, and they really didn't want to tell you about employment because it's pretty ugly. Let's take a look, because what we can see is the employment index for the manufacturing sector has been on contraction for 7 straight months. But look at this. Backlogs have been in contraction for 35 months. That's nearly 3 years. And the problem is it's contracting at a faster pace, meaning we're about to hit a point of no return. And when that happens, it's because all the backlogs are worked through and there isn't enough new business to sustain the workforce. When that happens, employees are going to hit the unemployment line with little to no opportunity to re-enter the workforce. So you think back why President Trump is looking at declaring a national emergency this fall? Well, it starts to become clear. The real issue is I think it's going to be far too late, and I don't think they're going to have any response that's going to be able to turn things around. Let's dig deeper here, because you can see the effects the manufacturing sector has on the housing sector as we overlay manufacturers' new orders of durable goods in red against new privately owned housing starts in blue. And you can see as housing starts go down, well, the demand for durable goods drops right along with it. And of course, we know when durable goods go down and enter a contraction, that means, of course, people are going to lose their jobs, hours are going to get cut, and the economy likely heading into a recession. So you can see the risk here as consumer sentiment dropped off a cliff, suggesting housing starts are about to go down, and that means that things for the manufacturing sector are going to get a whole lot worse. And again, you're setting the stage for a national emergency, one that I'm not sure the White House has a proper response to. But the real risk, my friends, and what I've been warning about, is the U.S. economy and the rest of the world are headed into a globally synchronized recession. But something I am bullish on, that is the stock for our sponsor for today's show, Clean Core Solutions. You can find them on the NYSE under symbol ZONE. Let's take a look here, because they're the Dogecoin treasury company with Elon's lawyer at the helm and an actual treasury deal backed by the actual Dogecoin founders. And Clean Core is all about smart, eco-friendly tech. Their ozone-infused water replaces harsh chemicals, making spaces like offices and hospitals safer and greener, saving businesses money while protecting the planet. But tonight, it's their financial innovation that's stealing the show. And here's the big news. Clean Core just landed a massive $175 million deal, the actual treasury deal backed by the actual Dogecoin founders through the Dogecoin Foundation and the House of Doge. Over 80 top investors like Pantera and Falcon X are backing this. It's a game changer and one you don't want to miss out on. This isn't just any treasury, it's the first official Dogecoin reserve sponsored by the Foundation and House of Doge. Clean Core will hold Doge as its main asset, fueling growth through payments, tokenization, and global use. It's about making Dogecoin a go-to for everyday spending worldwide. And leading this charge is an all-star team. Alex Spiro, Elon's lawyer and a crypto-savvy legal titan, takes the chairman role right away. Timothy Stebbing from Dogecoin Foundation joins the board, and Marco Margiotti from the House of Doge steps in as the chief investment officer. These are some heavy hitters. And Dogecoin's on fire with a $31 billion market cap and 12 to 15% yearly growth. It's perfect for fast, cheap transaction. Think tips, shopping, even sports events. Its passionate community drives real-world use, from Tesla merch to stadiums, and it's only getting bigger. And crypto treasuries are booming. $132 billion invested by these companies this year alone. And Dogecoin's market cap could hit $50 billion soon, with prices climbing 30 to 50 cents in 2025. Clean Core's treasury, the Dogecoin treasury company with Elon's lawyer, will tap into yield opportunities and global growth, making it a smart play in the market racing toward $1.8 trillion by 2030. Clean Core's partnered with 21 Shares, crypto product experts, to guide this treasury. They're planning staking rewards and asset tokenization, building liquidity for real-world commerce. This is how you turn Dogecoin into a global payment powerhouse backed by the actual Dogecoin founders. And let's take a look at the investment opportunity here, because this chart is impressive. Now, if you are a gap trader, this is what you're looking for, because you can see today, due to the market drop, that Clean Core, and again, you can find them on the NYSE under symbol ZONE, had a major gap down. But because of the Dogecoin treasury company, you can see investors flooded in today and drove volume up and price right back into the 6-month volume profile. Now again, if you're a gap trader, this is setting up a 100% move to fill that gap. And again, this is something you don't want to miss out on. CleanCore is unlocking huge potential in digital finance and sustainability. They're building a greener, smarter tomorrow. Check them out at cleancoresol.com to learn more and on the NYSEA under the symbol ZONE. And as always with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.